New no loss strategy. How to make winning trades. Now, my strategy is when you sell puts, you have an obligation to buy a stock at a strike price anytime until the option expires. You will need to have sufficient funds on hand to fulfill the obligation, so the short puts are cash secured. Now, this is one thing. In easy words, what it means is you're selling a promise that you will buy the stock at X rate. Let's say Apple at 20% lower than today. If it is trading today at $800, you are, let's say, committing to buy it at $680. So if it hits that amount, you will buy it. If on the expiry date, the other party asks you to fulfill the obligation, you will buy it. So you need to have cash in your account to fulfill the obligation. Although it is known, the major portion of all the traded options expire worthless. So you have a higher chance to make money. Now you might be considering, what if it gets hit a lower rate? If Apple is trading at $800 and you are trading an option puts contract at $680 strike price, what if it hits? Now you need to understand value investing. Now if a dividend stock gives 3% dividend yield, that is on $100, it gives $3 as annual dividends. And if the stock falls to $60, then the dividend yield will go up to 5%, right? Because at $100, $3 dividend meant 3%. But at $60, $3 annual dividend would mean 5%. So you as a value investor will jump in, because getting 5% yield is really hard to find. So you would jump into that stock as a value investor, and you will buy large quantities, as 5% dividend yield stocks are hard to find. So this is how the price never usually falls that much low, because like Apple, a good company will always attract new buyers. Mutual funds, hedge funds, they will always look at this kind of discrepancy to make the trade and make the most money. So if you put a options contract on a good dividend stock, then you have a higher chance to make money. Now to explain you in clear terms, if you own a $1.50 stock and you collect $1.50 for selling a $47.5 put option that expires, let's say, in 60 days, then you have picked up 3% return within 2 months. That is $1.50 on a $50 stock. So it's a 3% return. Now in the previous page, we discussed 3% dividend yield for the full year. Now here we are discussing 3% return on just 60 days, only 2 months. So if that option expires worthless in 2 months, your annualized return would be 18%. That is 3% for the first 2 months. In 4% it goes to 6. In 6% it goes to 9. In 8 months it goes to 12. In 10 months it goes to 15. And in 12 months it goes to 18% return. Now, who makes 18% return? By doing just a simple thing, buying a dividend stock. But before buying, he's just buying a put contract. So like Apple, if you're putting a put contract on Apple at $680 and today it's trading at $800, then that's a huge gap. Even if you put a put contract 10% lower than today, then even Apple is not bad trading at today's rate. Its book value is far higher. So you need to understand it. That's what the trading game plan is in puts option. You multiply 2 months by 6 to figure out what you could have earned by making the same trade again and again. Now, this example gives you a 3% return. But as per my personal experience, I've made 6 and 7% return only in 2 months. Just in 2 months. In the next chapter, we will discuss like the stock options page, where you will see some contracts, like some stocks, giving you 5-6% return. And in good days, the same some stocks can give you far higher rate of 7-8% just for like 2 months. If you make a 3% return in 1 month, then 6% return in 2 months is brilliant. That's what the game plan is. Now let us look at PayPal holding today. It's currently trading at $43.04 right here. Now if you go to PayPal holding option chain, you'll find its option chain. Now this is the call category. This is the puts category. Now if you look at it, it's saying a strike price of $42.50. You make a 2 cents profit. Now right here, you make a 95% profit by buying it at $44. It's currently at 43. Strike price is 44. Right? Now let us see it like in the future. So the plan is, first you pick a good stock, let's say Apple Holding. You know it's a good stock and you're willing to buy it. Now on April 13th contract, you put a puts contract. That is, it generates you 17 cents profit. Right? And you get to buy it at $40. Today's price is 43. So you get to buy it below like $3. If you buy it today, you will be buying it at 43. But you are like putting a put contract which makes you a return of 17 cents right now. And if it goes down, you buy it at like lower rate of $3. Isn't that a blessed? Because you are making money. Huge money. Now let us look at like other contracts. This is $2.20, but it's like a higher rate. Let us go lower. It's 11 cents, 13 cents. Now on a $40, 1% would be 40 cents, right? Now it's 13 cents. That means 0.3% return. Now April 21 is just 15 days. So that means on a monthly scale, you're making 0.6%. Now on 10 months, you'll be making 6%. So on the yearly basis, you will be making 7.2% return. And you will be buying it at a lower rate of 40-50 if it falls. If it falls. This is how it is. Making huge return just by following the plan. And if you look at the chart of say 1 year chart, then the lowest low is $39.31. And if you can buy it again at this rate, it's not a bad trade. You're buying it at the extreme low. That was on February 1. Other extreme was December 1, 38.34. This low is 38.94. This low is 39.20. So $40 is not that much bad trade. See, you're making 13 cents without doing anything. Just buying a great stock. That's what the game plan is. We will discuss in the next chapter some other stock. However, I need to show you one more thing. Now let us look at this contract, May 17th, right? And if you look at it, if you trade a May 5th contract, you're making 26%, 26 cents. Now, right here, May 5th contract at today's price of 44.50. If you trade this, you make a $2 return. At today's price, a $2 return. That is 5% return approximately. That's what we were discussing in the example. A 5% return for 2 months would mean 30% return a year, because 2.5% a month it makes it. That's my point is, you're not using anything special. You're just saying that on May 5th, I will buy it at today's rate, 44.50. Today's price is $43. Yeah, it's 5% higher, but let's look at a $43.50 here, 1.53. That would make it 40, 80, 120, 160. 4% return. A 2% return a month would mean 24% return a year. That's not bad. You're just buying it at today's rate. If you're already considering buying PayPal, then this is the rate. This is the game plan. You make money before buying your favorite stock. You're not buying today. And as we all know, 90% of the options expires worthless. So there is a higher chance of you making money. You will discuss another strategy that really fulfills the words how to earn before buying your favorite stock, because it will tell you which stock gives you the highest proportion of making money, highest return on investment before buying that stock. So stay tuned. Thank you.